Right, so I hope everyone can hear me all good now. I think audio seems to be getting picked up. Make sure that I'm actually using the right output device. Yeah, all good to go. Right, so picking up after the week's break that we had. I hope everyone had a good Easter and whatever. Um, so, like, if you've been paying any sort of bit of attention to the markets in the more recent time, you would have noticed that Bitcoin made another surge to the upside. So if you were keeping track of the Instagram, I would have been posting about it a good bit on the Instagram. I'll get it up in a minute. But as you can see, I'm doing a lot of analysis on Bitcoin at the moment. So as you can see here, there's a great thing here. I'll just give a quick little explanation as to what the great thing is, right? So I made a prediction there this morning on Bitcoin for it to be coming down to this area around here for TP1, and TP2 is down around here. So the way I formulated that kind of an idea was from a thing called the Fibonacci retracement extension, right? So you find that on TradingView over in here in the kind of mathematical estimation tools section. Just one second. So you can see here fib retracement. I have it favorited and everything. You can turn on your favorites just by clicking this star down here. So then you get this little box. Really handy. So that's a GAN fan. That's a completely different thing. I'm not well versed in using those or anything of the likes. So you can have your favorites. I have them turned off because I use TradingView a bit, not a huge amount on my phone, but I do use it a bit on my phone. And it just kind of clusters the screen, but when you're on the computer, it's really handy, because if you want to get the fib retracement, you have to go over here, go into here, go over, go down, click fib retracement, and then plot your retracement. And it's just time consuming, right? I never use this in grey. I just have it on grey because I actually posted up something about it, and I have to reset the settings on it. It's just in the color. There's a way you have to do it. I can't remember. It's probably in the settings, visibility, style, and use one color. No. I'm probably not seeing it here. Template, apply defaults. There we go. That's the one. So I never saved it. Very professional. Apply defaults and okay, right? So this is the kind of the colors that you'll see more commonly on the fib retracement. If you open it for the first time in TradingView or whatever, you're gonna see this big big massive kind of plot when you use the defaults. I have templates set up for my own strategies that I've tried and tested different retracements at different levels with different colors. So it's the grey one that I had set up is one of the kind of templates that you just literally put the grey color on it or whatever. But basically what the fib retracement does is, so we just clear it off it, right? So we want to predict the movement when we trade trends, so trade based off of the trend. What we're doing is, if we just throw it over to, I don't want to erase because I've done a lot of analysis on this chart, so we'll just hop over onto a blank one. So we'll just remove drawings. So we can see if we are doing trend based trading, right? So when we have an overall trend, so we'll knock this up to a day chart, and we can see that we've been, there's been kind of let's see, this is a typical downtrend, a solid, consistent downtrend, right, along here. Consistently hitting boom, and banging off it like that. That when you're in a downtrend, you're going to be shorting a lot, right? You'll be shorting in a downtrend, and using the Fibonacci retracement, we can predict price action, right? So it's a predictive tool, right? So if we're here with the Fibonacci retracement and we're looking at the chart here and we see this move all the way down to here, right? So we can use the Fibonacci retracement. This isn't an example that I've picked just for sake of it. I just went onto the Euro chart just to get it. So when we're trading in a downtrend, right, we're going to measure from the bottom to the top, and we're going to, so the absolute high and the absolute low of the move that in question. So if we were to draw a rectangle on this, we could draw the rectangle like this, and it's going to correspond with the Fibonacci retracement extension tool because we drew it off of those points. But those are the two. So it's from this high, so the high up here to the low down here. That's the move, right? So we drew it from here, and we're going to do that, and it extends it, right? So we'll just I'll put a basic color on it just so it I can do that just to because I think it'll show better on the screen if it's all colorful. So basically what we're going to be talking about is, we see the Fibonacci retracement, right? So I have a set of rules for my strategy with the Fib retracement. I'll do a proper video on this. I'll only go into it briefly. But we draw it based off of the move, right? So the move here goes from 0 to 1, right? And it's based off the Fibonacci sequence of numbers, which is you take 0 and 1, you add them together, you get 1. 1 plus 1 is 2, so then you add 2 together to get 2, then you add 1 plus 2, so you add the previous number to the current answer. And that's the way the series goes on. So that's the kind of way that the whole thing works. From a trading perspective, you don't really have to understand it to that extent. But what we're looking at here is we draw 0 to 1 on the move. So we start at the bottom, go to the top if it's going down, start at the top, go to the bottom if it's going up, right? But here's a move to the downside, right? And we see the price goes from here to here. But after the move happened, it retraced, right? And it retraced, so if it goes, so I have different rules for different, I have different extensions for different retracements, right? So the price comes down, stops, and it moves out for the retracement. So usually we understand when a market makes a move, it's going to stop and it's going to retrace back. And if it's going to continue the trend, it's going to retrace back and it's going to excel past that point. So in an uptrend and a downtrend. So if we just mark this with I always lose this tool, the pat tool, right? So if we have this, right, the price came up, price came back down, price retraced and came back down again, technically came up and came back down, right? So we're looking at this on the daily chart. So we're going to be looking at it kind of in a swing trade, so a week to a month kind of time period, right? A couple of days to a month kind of time period for swing trading. So we're going to have a move to the downside, and then we're going to have the retracement, right? So we can see that the height, it nearly got the whole way to the 23.6, so the 23.6, some people call it 0.32 or 0.236, or people refer to it by the decimal based off of the currency that you're trading as well. But you can disable all those kind of settings. But the basics of it is, it makes a move and we measure the retracement and predict the extension of it, right? So we can see here the price retraced nearly up to the 23, but it came to the 38 definitely, came to the 5 definitely, came to the 6. So if it makes a bigger retracement, it's not gonna pass it out by as much as it would if it made a small retracement. Because if price comes down and makes a big retracement, like if it comes to the 23 line, it's not gonna blow too far past the previous level in this move, but it might in the next one. So basically, when we do the analysis, so I'm looking at this now. So price came down, I measure a retracement. So I'm waiting. I see, okay, price coming to the 778 line. I see, no, blew through the 78 line, right? Price came up, blew through it. Came to this 61.8. It's starting to slow down. Dojis, I'm seeing, okay, this is turning. This could be turning around. We're meeting resistance, indecision, because we can see that there's resistance, support come resistance in this zone here. So we'll just mark it with a box just so we can understand it. So we can see that there's support and resistance across the board here, right? And that's all in the 61.8, the 51 point, the 68, 61.8, 0.5, and nearly coming up to the 38.2, right? So we're finding that the price came up. So we've seen price indecision in this area. So this could have been like, there's a bullish engulf, well, not bullish engulfing candle. There's no bullish engulfing candles here, so it's not showing considerable bullish pressure, but it is showing that there is bears and bulls fighting with each other. So when the price came back up into that zone, we met resistance, and see this here, right? A bit of a doji style candle followed by a bearish candle, but you see that there was very, very few bulls in the market here, because we can see that the candle wicked quite high. So we have, if I just get the brush, we can see a candle that looks remotely like this. So we can see that second wick isn't very good for the example. But we can see that there's a lot of bulls lost out, because if we see a big gap between the high, so if we're talking about a bearish candle, if we see a lot of space between the high and the close and the open of the candle, it means that the price tried to go higher and it fell hard. So as we know with the green candles, so the bullish candles, so we open at the bottom, price comes down, goes up, and settles at a level. And that's going to be the close of the candle. But we're talking about bearish candles. It starts high, moves up a little bit, comes down, and then closes. But if we see a huge move to the upside, but the close of the candle is very, very low. It's showing that the bulls tried to move the market, but they failed and the bears took over, right? So what we were looking at here is a similar candle with very, very little bullish pressure and a quite considerable amount of bearish pressure. And what would have happened is a lot of people would have shorted. So they see the bearish engulfing candle. Some people would have gotten in here, stops above the previous high, targeting. Based off of this, they would have been targeting down here. What happened? They got stopped out, right? So to the untrained trader, they're going to see that, and they're going to be, you're going to get stomped every time. Why? Because you're just trading off of Fibonacci, right? You cannot trade based off Fibonacci on its own. Fibonacci is only one of the tools that you can incorporate into a strategy, right? Trading off of this here, that's not considerable resistance. There's resistance and support there, but there's not enough. It's not a strong level. There's indecision. The indecision isn't a good. We have the solid lines of support and resistance, so we actually should have taken a step back and we should have actually plotted a couple of lines of support and resistance. So here's a little insight. So we have the horizontal lines, right? So we can obviously see there's a high there. Right, we'll turn on the permanent tool. So we can see that there's a lot of resistance in this level. So there's a couple of days that it wicked above, but nothing considerable. Price came up to it again, finding resistance, coming up again, finding resistance, came through, came back down, kind of found it as support, not directly, but kind of you can see that there is a couple of candles there that did in that. Oh, didn't mean that. I forgot I had the permanent tool on. So you can see that the price did come and it kind of flattened. Nothing was wicking down. There was no bears. The bulls were just kind of they were tying around with them. So we're looking at this now. This is from a swing trade point of view, as I said before. So the price would come down, and when it retraces, we're measuring the retracement to predict the extension, right? So we're looking here, and we can see that there's considerable amounts of resistance forming from these levels along here. We could even pull it down a little bit further if we wanted to include these levels, but then a lot of these highs aren't being included. Like, you could draw it off of that, but that's one touch. So when you draw support and resistance, as I said in the previous videos, you want to get as many touches as possible, and so it's kind of a line of best fit. If you remember from maths in school, it's kind of like a line of best fit between all the different points. So that's the kind of level I would have put along there. So we can see that level is quite close to that one, right? Close to the one. And if we make a small retracement, it's going to have a harder time getting through resistance if the resistance, or the support is at or close to that level. Fibonacci, I should just put out a disclaimer, it is not simple. Fibonacci, there's a reason why Fibonacci, having an in-depth understanding of the Fibonacci retracement tool, is essential to putting it into a strategy, and you need to have a well-versed knowledge in the tool and a lot of faith in it for it to actually be a profitable strategy, profitable incorporated into a strategy. So just quickly, right, I know I'm rambling a little bit. So we have the price comes down, right, and we plotted off of that, nothing else, the high and the low, and we draw it off that. We are watching constantly, right? People got stopped out here. That's going to happen. People are going to get stopped out. But then the bulls came in and drove the market up a little bit. No massive rise for concern. We're kind of meeting that area of consolidation or indecision, as I had it marked before, in this area. So we know there's a lot of indecision in that area, right? So when the market makes a move to the downside and makes its retracement, we're looking for, so the scale, we're going to scale down, right, for the sniper entry, because the sniper entries work very well with the Fibonacci, and it's incorporated into strategies that I have for day trading or even scalp trading. I don't scalp trade specifically, but these strategies can work very, very well with the scalp trading strategy. So price comes down, retraces. We know when the price makes a big retracement, it's not going to come too far past it. And what do we see? We can see the price didn't come too far past. It came, how many pips past the previous low? So if we snap it on there to that low and come to this one, we had 116 pips. It didn't come, well, obviously the move was a massive move, right? It's over the course of a couple of, so like we're talking the 6th, say the move started on the 6th of January, 7th of January, and ended a month later. So that's as long as a swing trade position gets. Like, people would have had their bailouts at the 7th, so the 7th, 6th, 7th, so it would have been this candle was the end of the week, right, the 5th. That would have been the end of the week, so people would have been on their bailouts there, so they got out of their positions then if they were swing trading in Fibonacci. So when we're looking for the entry, we're going to be scaling down. Like, we're not when you're swing trading, you're not going to be getting your entries off a day chart. You're going to be scaling down to the 4 hour, looking for your entries, right? And we're going to see loads and loads and loads of these open close things. Forget how to take them off now. It's probably in here. Session breaks. There we go. So we can see when the market came down, we're watching, right? So the 4 hours is my go-to for swing trades, right? 4 hour, little secret, 4 hours is the one to look at for when you're swing trading, right? I hope I'm not, I'm fairly well in frame. I just looked at the camera there, it was a little bit high. So we're looking for those real good entries, right? And watch out for false breakouts. I'm going to bring out, I know I said it before, but I bring out a video on false breakouts because starting off, I had awful trouble with false breakouts, because false breakouts, like, they are what they say they are. Price comes below, and it's a false breakout. It's fairly self-explanatory. It comes to a level, it breaks below, but then it continues to the upside, right? It happened on Bitcoin this week. We'll talk about that in a minute. But giving an example, in the most basic terms, I know I've said it a couple of times, price comes down, retraces, and makes another, and we use this to predict it, right? So did it actually make the level that would have been predicted off of this, right? And we have a look. And so this is, like, I would always say don't put it exactly on it, because everyone's going to be looking at the same chart, right? So if I have this Fibonacci, no, didn't mean to move it like that. So, like, if you set it up based off of the actual thing, you can't actually see the predicted levels. You can plot a line based off it, but it's better to just line it up by eye. There's no exact way to do it, because everyone's going to be lining it up by eye, so no one's going to be exact, right? So when we have it predicted, we are going to instantly, when we map it, we're going to mark the levels, right? So we're going to have horizontal rays, and we're going to just mark the 1.618, so it's the same as the 618 here. So we're going in the Fibonacci sequence. The predicted one is the 1.618, right? So we'll put that in on it there. So that's going to be I'd have it, yeah. So, like, say where the move happened, I wouldn't be putting it back here. There's no need. You're just going to be cluttering your chart, and we'll put it in just in line with the move. But you're going to mark it, but you're not going to put your take profit at that level, because everyone's going to be there. Everyone's going to be selling off in this region. It's like when you put a limit order. You put a limit order at 8, right? But price comes down and it comes to 8.02, but it doesn't quite get to you, and you miss out on the move, right? If you have a buy limit set at €6 or $6 for a stock, and the price is coming down and it comes to 6.02, €6.02, and it just starts to climb back up, but you're not involved. The market's making its move, but you're not involved. And that's basically the same thing with take profits. There's going to be huge amounts of people closing out their positions. They're going to be buying back, right? Because we're in a down market or downtrend. So with going long, you're buying it, holding it, and selling it when it's good, right? When the price is good. When you're shorting, you're borrowing it, you're selling it straight away. Right, at the current market, if you do a market sell order, which is an aggressive order, you're going to get a stock in your hand and you're going to sell it, right, straight away. Then you still owe your broker the money. Price goes down, you buy the stock back at the price when it's lower. So you sold it and you hold the funds. So say you sell something and you have it for a tenner, the market value goes down, you buy one back for 8, and you give it back, you keep the €2 profit. That's how shorting works. So when you're after buying it, so you're after getting it on loan, you're after selling, you sold it to someone else, but you still owe the broker thing, and you hold it short because there's huge fees on that, because the longer you hold it, they'll have to, if that person wants to sell their shares that they're after lending to you, they'll have to source them somewhere else, and that whole kind of way. So it's a kind of an abstract way of thinking about it. But when you short, you're going to be buying it back, and if there's a load of bulls coming into the market coming to your level, you're going to miss out. And you can see here, it's a very, very round number as well, right? So if we look at this, 1.17 even, right? €1 or €1.17 to the dollar even. Round numbers. I talked about this before. Moves happen at round numbers, right? If you look at Bitcoin, I always have in the current range. So I'll have the 65, the 60, the 55, the 50, all the different big 50,000, price brackets, all marked on the chart in big thick lines like this, right? I probably have them on 3-point lines like that, right? So I can always see when prices come into a considerable level, 51, 52, 53, 54, they're all strong levels as well. But when you have, especially in Forex, when you have a round number, right, when you're coming to the 100th pip, right, that's when you are going to have huge moves, right? If we look at this one, right, we're coming to the 1835, so you're coming to a round number. You're in the 35 rounds, so anything that's a 0, a 5, or anything in that kind of idea. So if you're coming to say we take this high here, 23.49, so that's going to be 23.50 or 23.40, the 39 to 40. So you're going to round that, or you'll find other levels of support or other highs and lows in that kind of region that you're going to kind of make it fit to a round number maybe, or something like that. You can be as loose or as tight as you want with all this stuff. But the considerable thing to think of here is that's a round number, so there's going to be limits on the upper side of that. The smart traders and the clever lads are going to have theirs at 17.05, right? They're going to have them 5 pips above it, so they know they're going to get in. They mightn't get those 5 pips, but they know for certain they'll be in on the move, and they're sure. Look, we marked it before. We know there's considerable resistance in this area. It was broken through, kind of a retest, and it blew up to the upside, right? So we're looking at previous price action to predict this. So we know this is coming down, right? And see, look, obviously we met. Look, it broke down, came back up, and it kind of messed around at that level, and then broke down, right? I'm just going to get up the analytics as well, just in case there's anyone sending in a message. If you have any or any questions or whatever, just let me know, and they'll pop up on the right hand side here for me as well. But because I know the Fibonacci is really, really confusing. It puzzled me for the longest time, but it is the best thing I think you can learn from a trading point. Day trading, I think, is the strongest thing. I know I'm showing this to you from a swing trading point of view, but the Fibonacci retracement extension tool is the best. If you look at any of the big Forex traders, if you look at Daniel Savage, Bamba FX, if you look at any of them fellas, they push the Fibonacci, and they push it for a reason. They're experts in the Fibonacci retracement tool, right? As am I. I know this tool inside out, and this is one of the best strategies that I have. One of my best strategies includes the Fibonacci, right? It's not the Fibonacci. I'm not saying the Fibonacci is the be all and end all. This here would have been perfect if you just went in off a whim and used the Fibonacci tool on its own to predict this trade. You would have been profit. Well, not necessarily, because if you use it, because you're going to be using it to set your stops, you're going to be using it to set your take profits, but you don't have entry reasons based off of this. You're getting to see how far you're going to put your stop, how far you're going to put your take profit. This isn't telling you your entry reason. Entry reasons are bullish engulfing candles, big market news, if you're talking about stocks, CEO resignations, earnings, dividends, splits, all that stuff, right? In the Forex markets, there might be huge funding. Like in America, they're after putting $26 billion towards NASA. So all the kind of, space exploration, all those kind of things, tech companies involved with NASA, watch out for those. Little tip. This week I picked up, just as a little side note, I picked up a few shares in JD, Aviva, and Rolls-Royce. 3 small cheap stocks. If we just quickly, actually I'll go into that in a minute, but I hope anyone that's here understands what I mean when I'm saying the Fibonacci, and it's something to read up on, right? And if I do just retracement, just put Fibonacci retracement in, right? Investopedia, if you ever have any questions about trading or investing or anything, Investopedia gives you, it doesn't really simplify anything. So if you're not well versed in the whole world of investing, it can be a little bit confusing, especially when it goes into the likes of lot sizes and pip value and all that stuff. So pip value is a big complicated topic. If you want to get into the nitty gritty of your profits and all that, you'll have to know about pip value. So it's basically taking your, it's for another day. There's a calculation you have to plug in the range of the the move you're predicting and multiplying it by the market value. And if your currency is involved in the pair, if it's not involved in the pair, you have to go to a pair that's traded against your currency and then convert it from there. So it's a big confusing thing. But this website is very, very good for anything to do with trading. So you can do technical analysis, concepts. This is technical analysis, obviously, because you're looking at the charts. But if we go back over to the Euro USD, the Fibonacci, what we're looking at is price comes down, we measure the retracement and we predict. So when we see the price coming into this area, it's retracing far, we're going to be looking at a shorter term prediction. And you can set up this in any way you feel the need to. You can have it set up for a 1.22 line, which I always have on the chart. So this is the basic. If you go down to the template, apply defaults, it knocks off some of the good tools to have on the chart. Like, you wouldn't be predicted, this is long term again. You wouldn't have some of these real long kind of retracement stages on your chart, because I think they're, you're shooting way too far into the future with these kind of things. But you can see here, right, exactly what's on the screen is exactly what happened, right? It predicted to the pip, right? You enter here, right? You put your stop, right, at a reasonable. So if you're entering off of the 0.5, a fairly good idea would be to put your stop, in the region of the 23. The 23 is a good one. If you're entering around the 5, if you're entering around the 3.8, above that level is a fairly good one, because if it makes a big move, it's unlikely that it's going to pull up through if the other parts of your strategy are showing that's why this strategy doesn't always work. Because see, if you target the 22.72, right, exactly, right, in this instance it worked, but in another instance you might miss it by a few pips because of all the limits at that level, right? So I have this and I enter, I don't know, we'll just cherry pick a nice a nice example. So bearish engulfing candle off a doji, right? So we'll enter off that, right? There's our market entry, right? We're after analyzing, we're putting our stop above the 23, right? The 23.6, and we're going to target 72. Why? Because I told you, if it makes a big retracement, if it goes past the 0.5, you're talking a shorter retracement. If it makes a small one to the 78 to 61.8 in that region, right? If it came down to here and retraced up into this region here, right? It didn't break above. It was trading in around, hitting off that line, hitting off this one. It would have broken down to here, right? And in the grand scheme of things, it did break down to there eventually. But we enter this position, perfectly cherry-picked example, coincidence. It's what all the gurus will show you, all these cherry-picked perfect examples, because they're, well, it's good for the educational purpose of showing it, but in practice it's not always this simple. So you're not going to pick an example like that. Like, you're in this position for so from the 25th of February the whole way to the 9th of March. So you're in it for a good 2 weeks in this position. But like, that's a completely acceptable swing trade. You're in this for, well, you're like, trading isn't a short term game by any stretch of the imagination. So if you're in a position for 2 weeks, it's if you're more comfortable with a swing trading strategy where you only check your charts once a day, all that kind of thing, just make sure news is all good, all that kind of thing, that's perfect. You can completely run a strategy that way. But we can see that we put the stops above the level, right? So sometimes if you take the ATR, right, here's a bit of a insight into one of my strategies. If we take the ATR indicator, average true range, which measures the volatility, right? So if we look at this exact moment that we entered, right, we have on the ATR, it's not actually showing the data that we need, down here, there we go. It's showing us that we are at the market entry, there is 32 pips of volatility on the 4-hour chart, right? So 32 pips, so basically there's an average move of 32 pips every candle is what that's saying. It's the average over the last 14 candles. So there's an average of 32 pips on every move over the last 14 periods, right? So we enter and we pick our stop at 90 pips and we add the ATR on, right? So we're going to put our stop at, so we just do it roughly. So if we're at 90, we're going to go to roughly about 120 pips, right? take it there. I'm not going to fudge around with it for too much. Then we know where our take profit is, but we're not going to put it exactly on the 27.2, yeah, right? So we're not going to put it exactly there. We're going to put it a couple of pips above it. Why? Because we're smart and we're not going to miss our take profit. Because if the price comes to here, it's not going to take our profit, and it moves back. Say this move, right? Say the 20. We'll just, for the purpose of the example, I'll just fake this a little bit. So say there, right? It didn't quite make the level, right? Just barely missed it, and we had our take profit right on the line, right? And we had our bailout. We were in the position for a maximum of 3 weeks, right? So from the 25th, you're going to be talking. Well, say the 2 weeks would be to. Just call it, that was, we were saying no longer than the 11th of March, right? We weren't going in it for any longer than the 11th of March. And look where we are. We missed the take profit. But if we were clever and we put our take profit just above, how many pips above? So that's 35. But 5 pips above, we would have been in profit. And that's why you do. That's why you always measure it accurately. Measure it by eye, but measure it accurately, right? And you put your take profit on the 1.272 line, but a couple of pips above it. That's my recommendation. It's the best way to do it, but you have to have your other things in on the strategy as well. Short term, we'll have a look at the short term, right? We'll clear up the chart, move drawings, right? We'll knock it down to a 1 hour, right? So we can see here. Right, we'll throw it back a little bit because price has been a little bit kind of, we're starting to uptrend again after a big long downtrend, right? Over the whole of 2021 has been just a slouch the whole way along. So we have, say we measure this just for the sake of the example. We'll take this, right? We'll take this move here, right? That's actually a fairly long-term position. So we'll go for a more short-term position. So look, we'll take a day trading standpoint on it, right? This move, right? This move here, right? We're going to measure that for our next one, right? So there's the move, downtrend, right? We've established, okay, market might have moved to the downside. I measured it off at this high down to this low. Actually, it should be this low, the other one, right? So now we know, actually I'll drag it over just so we can see it overlaid on the data, because that's the way you would draw it. So we see the price come down, made its level, and it retraced. It came up to the 5, so we think, okay, it's going to make it's not going to be a huge move, but it's not going to be a small move like it would be if it came up into the 38 to 23 area, right? So we're there thinking, okay, there's not really much of an entry reason here now on this particular example. Just looking at it, there wouldn't be anything jumping out at me instantly. Oh, get in here. Like there's kind of a bearish engulfing candle, bullish engulfing variant, bearish engulfing, and a lot of indecision, because you can have indecisions in engulfings fighting against engulfings as well as dojis and pin bars and shooting stars, morning stars, all that kind of stuff. These are all candlesticks. If you want to just Google candlestick variance forex, if you want, just to make sure there's no questions, I'll just throw that up as well. So you can see that this example didn't make the level, right? But what did we say? We knew that it's not going to make a short move or it's not going to make a long move because it's kind of moving into the middle. So if we, using that logic, right, this is a perfect example. I didn't have these examples premeditated or whatever, but say you said, okay, I'm entering off of this, regardless of what happens, right? We came to the 0.5, so yeah, stops would be, say, in this region, above the 38.2 would have been okay. Obviously, looking at previous data, we can tell that it was okay, but say reasonably nice kind of a stop loss there, right? But we're going to target, so we could target here. You can be safe, you can always be safe and take a small look at 1.5 hour trade. Absolutely nothing wrong with that, right? Or you could have targeted here, but I like looking at the way that the trade panned out, obviously, but we can go into the replay mode, right? We can throw the thing back here and we can watch the move happen live, right? So we can say, I'll actually look just as a kind of a live trading example, right? We can be looking at this and we can see the price coming. So, oh, there's the move, right? And just to point it out, this is the euro dollar, right? on the 13th of January, right? The 13th of January, so if we knock this back to January, 13th of January was a Wednesday, right? Right? So the middle of the week, height of Forex, right? So we have a 7 o'clock in the morning. That was when the move starts. It always starts early, right? The move on the euro dollar, your European markets, the London sessions starting to move, starting to accumulate. 8 o'clock, 9 o'clock in the morning, really on its way. Look, 8 o'clock, 9 o'clock, 10 o'clock, 11 o'clock, meeting a little bit of support from the bulls, pulling back down through it, right? Watch this. We know we have a level, right? We know we have a level of resistance, or sorry, support. I sometimes say the wrong thing, right? But we know we have a kind of a zone here, right? A support turn resistance zone in this particular area here, right? So we know that if there's price coming into any of these zones, we know what's going on, right? So if we resume this, we can see price coming down. Okay, we notice, look, wick down, right? Sellers tried to come in, but just they didn't have the power, right? So the bulls just pulled back up a little. So technically we could have drawn our Fibonacci retracement to this, right? We could have said, yeah, that's our move. We're gonna measure that move, right? So we're going to be there waiting for our we're drawing it off of that level, not the next one, because prices after kind of moving on before we stopped it. So we could have watched this move, and we could be saying, okay, right, that's the end of the move, right? But we'll just watch, we'll slow it down a small bit just so it doesn't, right, so we can see price, okay, starting to pick up. Oh, price broke down further, okay, we're watching, we're seeing what's going on, hour by hour, day by day, whatever we're looking at. But we can see here, a huge bullish engulfing candle. That's the end of it. That's the end of the move, right? We can take it, we can rest assured that that's the end of the move, right, at that particular point in time, right? So now we watch, right, actually before we resume, right, we're going to redraw the Fibonacci, and we're going to line up one with that candle, so we can see that's our move that we're dealing with now, right? So now we're going to watch, and we're going to see, is there any considerable reason for entry? Nothing yet. We can see that there's a huge kind of a false, we could say that's a false breakout, because what can we see here? We can see a level of support, and we can see price broke below, but bulls came in and forced it back up above. Bulls said, no, this price is not that worth 21.10, so we're coming close to the 21.10 level, so it's a round number, and we'll just see how price went from there. So we could be thinking, okay, so we're sitting here waiting for our short position, because we're here downtrend, we're ready for our short position. So we have the button ready. If we're going to do an aggressive entry like a market order, typically with the fib, you're going to have kind of a limit order set. You might have a strategy that you might think, okay, on a specific currency, I can always short on the 0.5 and target the 21.7, and I'll always, well, not always, there's no guarantee ever in the forex markets, but you can have a strategy. I'll enter on the 0.5, I'll put my stops above the 22 or 23.6 line with an extra 10 pips of room, right? So you put a 40 pip stop and you make a 2.14 R on your trade, right? So say that was the position, that was my strategy that I'm putting here. I have not back tested this strategy. Don't anyone go and trade this. I'm not saying this is a viable strategy. I just pulled it out of my head. So we're saying, okay, price came up, right? So if we said, okay, straight away after the move, price came up to the 0.5 level, and we enter, right? And we put our stops 10 pips above the 23 line, right? So if we just put it 10 pips above 10 pips, so that's at say 30, we're going to put our stop at 40, and we're going to say, okay, our trade, we're day trading, so we're entering at 5 o'clock in the evening, so we go until 5 o'clock the next day, and that's 1700, right? So that's our strategy, right? It's not a very good strategy by any stretch of the imagination, but that was our aggressive market entry, right? We entered there, or we had our limit at 0.5, and we entered the trade straight away, and look, straight down, hits our take profit. Well, actually no, that's a prime example. It didn't make the take profit. We have it at that level, but no biggie, right? So that strategy, that's very, very tight for such a, expecting such a move, like a 75 pip move. You're expecting that in a day, like at 6, 7 o'clock or 5 o'clock in the afternoon. It's a lot of the London session done. The New York session is well underway as well. So you will typically see moves either at 7 or kind of 2-3 o'clock in the afternoon, because those are the start of the sessions. You'll have a lot of whether people are bullish on things. So you could have overseas, over in America, you could have a lot of people bullish on the euro dollar pair, and in England or Ireland or Germany you might have a lot of people short on the euro dollar or whatever. So you could have a lot of those kind of things in London session when the Americans are still asleep. You can be kind of you could drive a market a specific way when the lads are at the other side are ready to come in with all their buy orders at market open or whatever. Well, there's no market open. It's just when the kind of economy starts to pick up, like if the stock market opens at 9:30 every morning, that's when the American session would be well on its way then, as would the London session on any given day. But we can see here that price came down, just barely missed our stop loss or our take profit, and we can see that we smashed it there just at the 5-6 o'clock on the next day. But if we applied that little bit of knowledge I gave you of the 5 pip little cushion, right, if that's at 87, so we'll put it back to 83, smash the take profit, all good, happy days. It's a very, very tight strategy. The tighter the strategy, the less risk, the less potential reward. But if we were trading a little bit more loose with the fib is good for kind of a loose kind of a trader, because you're kind of eyeing things up, you're making predictions, loosely predicting stuff, so you're not going to be pinpoint accurate. You're not going to be hitting the bullseye every time. You can do everything in your power to be as pinpoint accurate as you can, but it doesn't necessarily mean that you are going to be dead accurate every time that you do look at a chart. As with any strategy, you're never going to be always right. There's no strategy in existence, and I said this in the last video, the last live session. I said it in every session. You will never have a 100% win rate, right? I have strategies that have great win rates of 60-65%, right? Because if you think about it in the most simple way possible, if you have a 50-50 chance on every position, it's not always that, right? It's unlikely for a position to be a 50-50. You either take the position that's in your favor or the one that's not, right? And it's not guaranteed that the one that's in your favor, because it's all based off a chance. You can do your calculations and whatever to figure out whether a trade is worth taking or whatever, but you don't have to take it. There's no one ever telling you have to take a position. But if you have a 60-40%, if you're 60% in, if you buy this, it's going to work out for you. If 60% or 40%, you're going to, if you sell, you'll win. It can easily win on the 40% as it will on the thing. It can win on a 10-90 split. But with strategies, if it was a 50-50 and you lose, if you have a 4-1 trade, right? If I just draw quickly here, right? This, and I set, just call it a 20 pip stop and an 80 pip target, right? So just put it on 80, right? We can see that we have just about a 4. So if we just put it so it goes to 4 flat, we get it as close as we can. Yeah, there's our risk to reward of 4. If we lose 4 positions and win 1, we're at break even, right? If we win 2 trades and lose 4, we've won 80 and only lost 40, right? So say we're literally trading with a €10 stop loss, so your stop loss will lose you €10 every time you lose, but if you win 40, right? You win 40, you lose 10, right? You won 80 but lost 40, you're 40 in profit. You've lost 2 trades, or you've won 2 and you've lost 4, right? So if you do the maths on that, you're going to obviously see that you're losing more than you're winning, right? You're losing twice as much as you're winning, but you are still profitable. And that's the whole concept of trading. You need your winners. You can have less winners than losers, but you can still be profitable in the end, right? So if you have this trade, that's a win. The next one, there's a loss, you get stopped out. And over the week, you have 10 winners and 25 losers, right? Say that massive figure. I don't know off the top of my head. If you weren't using good risk management, you'd have your account blown on 25 losers, and that would be a considerably bad week for a lot of people. Having 25 losers in a week, you would be trading a hell of a lot you would be definitely at this full time to be pulling that many trades in a week. But if you had, just take it simply, right? If you take 5 trades and you win 2 and lose 1 on a 4-to-1, if you're taking every trade you take is a 4-to-1, right? You're going to win 80 and you're going to lose 30, right? You're going to be left with €50. You're going to be very, very happy with that €50. Even though you've lost more than you've won, you're still profitable, right? That's the whole concept of the kind of trading thing, right? So yeah, look, we're after talking about the Fibonacci, and I think I'm after kind of rambling and confusing you enough with that. So we'll park that as was, and we can just see that. Look, we took our profit. I think, yeah, it didn't go too much further below whatever. It doesn't exactly matter too much, to be honest. We can scale that back and have a look at how the trade went or whatever. It doesn't really matter. But the next thing, I had someone text me and they asked me what broker I was using. I mentioned this before, but they mightn't have caught the session, right? And the broker I use is AvaTrade, right? What I like about AvaTrade, right? We'll just go in onto it. They have a couple of funny videos from years and years ago. I don't know why they still have them up. It's horrible for their image, but look, you can't. They've never done me wrong. We'll put it that way, right? So what we'll just have a little read down through the website, right? This is a big thing, right? And I'm gonna probably bookmark this, or however YouTube does it, for a video kind of purpose. But we can see here. So there's an app on the phone that you can get, and I just have it up. I've only 4% left on my phone, but you can open it up. It's the AvaTrade Go app. Really, really handy. You just log in onto it. You can have your demo. You can have your live account on it. You can trade Forex. You can trade gold, crypto, stocks, the whole lot. You can just go in. You can search up whatever you want. All good. You can, there's hundreds of different little kind of subgroups of different things. You can have American ETF, American stocks, bonds, commodities, crypto, and all that, and your account will be leveraged differently based off of all the different things. So if we just go in here and have a look at Forex, we can just click into that, right? You can do your register, try a free demo, you can go down through all the stuff. Look, there's the login button there, but you can go, and let's have a look if we can. So you can use MT4, so the difference between MT4 and MT5, MT4 is Forex only. MT5, you can trade CFDs, ETFs. You can do all your AvaTrade trading through MT5 if you want it. If you're purely Forex, I would recommend you go with MT4, because you have the extra potential for trading with it. It's not necessarily a good thing, because it can get confusing and cluttered. And if you type in E into MT5, you can get ETFs on different things. Anything that begins with E will pop up, but if you put in E, it'll be all the euro pairs, and the first one you're going to get is the euro dollar, because that's the most traded currency pair in the world. So it can be confusing in that regard. Or if you misspell something by a little bit, something completely wrong will come up and you'll be all over the place then. And I would recommend, if you're doing purely Forex, to get MT4. It's obviously you have to do your deposit and all that, but it is a free software that they will provide you with. If you just look down here, you'll see it here, Ava MT5. I use MT5 because I trade gold and crypto and all that, and I can do that all through the MT5 platform. But I don't use the MT5 platform anymore. I use the AvaTrade Go app, because I find it much easier to open the position. I can just have the phone there and just go boom boom boom, enter the lot size and click the button, and the trade is there, or set the limit, instead of going, okay, I have the two monitors here, but I find that easier for analysis. I can have order books open. I could have like 6 order books on this screen, especially for crypto. It's really, really good for crypto. You can see, especially when there's a big like we saw on Bitcoin the other day, we can see just quickly to show you the chart, major Forex notes on that. It's in crypto, Bitcoin, right? So we can see that the big move that happened on Friday night is right here, right? And by just having an order book open, you can see all the bulls coming in, right? And you can see the size of the orders the bulls are putting in. You can see like when you see a big crypto order, you know there's an institution in the market. If you see a couple of them, there's a couple of institutions in the market. They're all chatting to each other, saying, "Look, I'm gonna dump this amount of money on Bitcoin tonight, and we're gonna drive it and whatever." So that's where these big moves come out of. And being always like, this was one of the most embarrassing positions I've ever taken, but we won't even talk about that one. But we'll get back to the average trade thing. So MT4 is Forex, right? And we have MT5 for your CFDs, ETFs, cryptos, and all that stuff with average trade. I use TradingView. I paid 180, I think it was 180 euro back in the Black Friday sale for the Pro Plus of this. So it's saying to me, pay now and upgrade later. I have the Pro Plus. I got it on for half price in the Black Friday, so I would recommend for Black Friday invest in at least the Pro. For this, I think it's only about 90 quid. If you're trading with any size of an account, you'll have that covered over a couple of weeks. If it's a very small account, it'll be a couple of weeks covered, but then it's all kind of plain sailing from there, depending on if you're paying for news providers. Like if you have Street Insider or something is the name of it, they have a charge on that. If you're using FinViz for stocks, excuse me, for the elite version, that's €25 a month. I don't pay for that because I don't use FinViz in the way that they intended to be used. Like you can do all your if you go in onto your, you can set up like lists and you can do weird kind of filtering options and all that with the elite. I don't think it's worth the money, but absolutely TradingView is, like, you don't have to pay for it by any stretch of the imagination, but like you can do the charts that started all blah blah blah. There are ways of marketing it, but I think having 5 indicators option is good, because you can have, if you want to have 3 moving averages, an RSI and an ATR, but you're capped. You can't go any higher than that. You can't have a volume indicator on. So like a fairly decent strategy would be to have ATR, 20, 50, 200 moving average, and RSI and a volume. That gives you a hell of a lot of information. But if you can't have, if you're limited to one indicator, if you're very good with the point editor down here, you'll have no problem coding up something that will have the ATR showing, the RSI, all in one indicator. So if you're good, I actually don't think you have access to the point editor on the free version, so that's one thing to remember. So if you are thinking about it, I don't think you get access to the point editor on the free version for that reason. I think that's how they kind of cap you from doing that, so just bear that in mind. But if you are getting into trading properly, not necessarily professionally, technically you're professional if you're making money from it. So if you're, but full time, you don't necessarily have to be getting into it full time. But I would definitely recommend TradingView for anyone that's involved in, like, they're always like, I've given them €180 and they're still saying to me, upgrade plan, pay nothing extra. Like, I'll have to pay them the balance obviously if I want to go up to the premium, but I see no need in having 25 indicators, 8 layouts on one screen, 400 server side alerts, all this stuff. Like, actually the 400 server side alert, I don't need more than 30, but that would be handy if you were doing massive scalp trading and all that kind of stuff. Very, very handy. And you get access to second charts as well, so if you were scalping, you would be making a considerable amount of money short term. But as you've seen before, the lowest I can go, I think, is it's either a 5 or a 1 minute chart. Actually, I was clicking the wrong thing. So if I open up the full feature, so we'll just go, I think it's enter 1. Is it 1? No, I have that point editor open. Close that. It's in here. Is it? Yeah, just do 1 minute. It'll show me the 1 minute. So the 1 minute is the lowest I can go. I can't go to a 30-second chart. It'll say upgrade now, and it'll basically tell me, yeah, get over and get the premium plan. But I see no need doing that, to be honest, because it just doesn't constitute the extra fund, the money. Because like, I have never clicked on something other than that looking for the next step in the membership. So right, we get into AvaTrade, because I definitely recommend AvaTrade. And if anyone knows, anyone has talked to me about trading before, I recommend them because they are based in Ireland, so their headquarters is in Dublin, and they're regulated by the Central Bank of Ireland. That's enough security for me to trust them with my money, right? Because obviously I'm logged on from Ireland, so, and I live in Ireland, Irish citizen, the whole lot. I just find they mightn't be the best for international clients and all that, but I find that they are the best for what I'll just give you one example from YouTube, right? God only knows what's going to pop up on this, but if I go AvaTrade, right, like this, and go scroll down. If you go into their videos from years ago, right? I don't know, sure, they have 1 month ago, all that. So if I just go and filter it by date oldest, right? They'll have videos from years ago, and they have really weird, like this kind of stuff, right? Weird videos from years ago that kind of ruined their kind of, not their reputation by any stretch of the imagination. I watched this one, I don't know what that one is, but it's just a lad gets into bed with 3 women, and sure, like, it just goes nothing from there. Like, it's just, you know, obviously it kind of shows the kind of flex of a someone with money kind of thing. So but other than that, I think they're very, very reputable, very, very good customer service. I had issues logging into my account last week on Thursday, and it wouldn't leave me in on the app, it wouldn't leave me in on the thing. I rang up, instantly got in contact with someone, and they sorted it out, no bother. So in a couple of minutes I was back online, no bother at all, right? So, like, for that reason, I just think it's great. Like, they have their number there, you can just ring them up, it'll just be like, welcome to Avatrade, and there's all that kind of stuff. It's kind of like a robotic American voice. But what I like is they have education, right? So you can go on, and if you're an absolute beginner, you can go in and you can just, how to trade stocks, what is currency trading, what's copy trading, all this kind of stuff. So they do have a kind of a social thing like eToro. They have a kind of a copy trade, so you can just click on someone's profile. Every time they open a position, they will you will open the same position, and if they're a profitable trader, you'll be making the same profits. But the thing I don't like about that is that's very, very easily manipulated, because if that person's account gets controlled by someone else, they can force people to open positions in ridiculous circumstances and all that kind of stuff. I don't trust all that. So, like, having something enabled that someone else has full control indirectly over my account, like, they can open any position, close a position or whatever on anything, and I have no control over whether it happens or not, just by enabling something. And there's zero commission, and they basically, when we have a zero commission trade, right, if the thing is marked as zero commission, your trade is sent to an NFT firm, right? And I think NFT is the abbreviation. And basically what happens is your order is sent to them, and it's kind of designed, it's intended to give you the best possible price, but it doesn't happen, right? It's the long and short of it, right? You don't get the best price by doing the zero commission trading, right? But paying a small little small commission, which is proportional to the amount you're investing, you're going to get much better entries, right? If we look at the spreads on Forex, on the Euro USD, we're going to see that it's like 0.9, less than a pip, I think is all it is. Spread retail 0.9 pips, right? Very, very, very small spreads, right? And you get what they, you know, if you weren't getting that, I know when I started there was 1.8 pips and 1.6 pips and all like different amounts of pips based off of things. So like they offer to pro accounts, you have 400 to 1 leverage. Forget about it. Forget about high leverage. You will blow accounts. 30 to 1 is the absolute most I'd ever say you'd ever want to risk on a well, like in terms of leverage on a trade. 30 to 1, the absolute highest leverage you should ever even think about. So what else will we talk? And that's for euro dollar specifically, right? So on Forex, I know in stocks and other things they require lower leverage, like 1:20, 1:10, 1:15, things like that. So if we just go into what is Forex again, and we go to, is it in trading, is it here, trading calculator. I know you can get to it from here. You can go to the financial instruments and Forex, and you can get the spreads. So is it here somewhere? I think so. You get told spreads. Where's all the stuff? It's to do with leverage on Forex pairs. I can't remember exactly where you get all this, but if you log on to this website, you can get all this information for free. Here it is. So in Forex, you get, so on Odd USD it's 20 to 1. On NZD USD it's 20 to 1. the margin you need to supply to trade the position. So you need 3.33% of the position you want to take in your account to as the buffer for if your trade goes on its head. In stocks, it tells you can on Groupon you can do 5-to-1, Apple 5-to-1, blah 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 blah. Smaller companies you get less leverage. So if we go to page 62, 61, give me an example. These are all the pages of loads of different stocks you can trade using AvaTrade, right? So you need to basically 5-to-1 leverage means you need to front 20% of the amount. So if you want to do a position of 100, you need to be able to put forward 20. If you want to do a position of that's the easiest way of explaining it. On gold, 10-to-1. So like gold, you have gold there. You have gold futures, oil futures, crude oil, corn, all things like that, right? You need to supply 10%, and that's basically leverage, right? ETFs, so if you're looking at S&P 500s and all that, so you can't directly trade an index, you have to trade an ETF that tracks that index, right? So you can trade indices on 1:5 leverage, or just fronting 20% of the premium. So if you want to do €100 in say it was ETFs same as some of the stocks, so you want to do like Shake Shack Incorporated or Sony or whatever. So like we go back to Apple, right? You want to buy €1,000 worth, say each share is 200, you want to buy 5 shares, you need to basically, if you want 5, you have to pay for one yourself and they'll pay for the other 4, and you hold those. And then basically with leverage, if anyone doesn't understand what leverage is, it amplifies your profits, but it also amplifies your losses. So if you make say it's 5 times, so if you make 5 times the profits, you could also lose 5 times the amount that you could lose. But if you're using good risk management, you're not going to lose as much as you should if you're not using risk management. So cryptos, you can do 2-to-1. So if you're talking about so Bitcoin Cash, that's a cheap it's cheaper compared to Bitcoin. It's like obviously not a cheap cryptocurrency by any stretch. It does track Bitcoin against the euro, Bitcoin against the dollar, so you can trade all these different pairs. You can do Litecoin, Ripple, Bitcoin, and just so many. The list goes on. Actually, for one thing about AvaTrade, they don't have the biggest cryptocurrency pool, right? So like you can do the major ones. You can do Ether and Bitcoin are my go-to cryptos. I don't deal with Elongate, SafeMoon, SafeMars, Dogecoin, all these meme things. 5% of your portfolio deserves, it'd be lucky to deserve 5% of your hard-earned money is all you should be putting into meme stocks. And that's all I've done. Anytime there's that thing on Wall Street Bets where they say, hey, look at this hidden message in it and all that, 5% is all you should put on it. I wouldn't risk any more than that, because it's ludicrous following those kind of meme stocks, in my opinion. Other people will say different, but other people have their opinions, but that's how I feel about it. So like if we go over they have their most popular ones. So at the moment, currently, these are what they're recommending. Least popular ones, so Eurobond, FTSE MIB, FTSE 100. These are what they're saying is the small, they're not being traded much on their platform. If you look down here, 71% of retail investor accounts lose money, right? That is lower than the average. So if we go, what would we say? So 70. If we just say retail investor accounts lose money, right? So between 74 and 89% of retail investor accounts lose money, right? This is all women can trade thing on Reddit. 75% of investor accounts, 90% of retail investor accounts. So we can see that, and they cannot put this down here legally if it's not true, right? So if someone said to them, look, I want to look into this, is that figure true? They have to put a legit figure there. And to be honest, with spreads that like what they have, I wouldn't look too much further. Like you have your forex options, your indices. I wouldn't look too much further than AvaTrade. If I was to recommend any other brokerage, the names actually slip in my mind. Interactive Brokers, they do they're more for stocks now. To be honest, I was rejected off their platform for being too young. So maybe in a couple of years' time, but to be honest, I can't see myself moving to, unless in the future I have trouble with withdrawals or transaction fees or anything like that with AvaTrade. I will be staying with AvaTrade, because they've never done me wrong, and that's and that's me saying this. Being honest, I've never customer service is A1, withdrawals, with deposits, all that stuff. Never money going astray, nothing like that. So I would definitely recommend AvaTrade to anyone. I'd stay. Look, getting started with £100, throw it into trading 212. Throw it. I wouldn't recommend eToro. I don't like eToro. Trading 212 is as far as I go. Plus 500. Their ads just they're too misleading for my liking. Trading 212, Trading 212 have great videos. So if you're YT Trading 212, we just put that in, Trading 212 on YouTube. They have a great YouTube channel, 700k subscribers. They have loads and loads. Look, false breakouts. If any of these topics that I bring up, they have very, very good videos on any trading related topics. They have, they do the NFT, not NFT. That's if you buy a tweet, you can buy tweets on NFT, but I think it's NTF or something firm, but they do send your orders to them, and you get a lower, you get a much higher spread, right? And that's how they make their money, based off you. Off of the larger spread. Excuse me, my voice is gone. They make their money based off of higher spreads, rather than actually making money from you paying them a commission. So the broker has to make their cut, whether it's through giving you a bad spread or through taking a commission. So that's how that works. But Trading 212, I wouldn't look too much further than there. They're great for anything that you could think about when it comes to trading. Trading education, they have great videos. But I feel my money is safe with AvaTrade, especially if you're Irish. Open an account with AvaTrade. You do need all your proper information. You don't need birth cert, but you need proof of age, proof of ID. So they obviously have your age, your name, your PPS number, all that stuff on that. You need proof of address dated within the last 3 months. It's a long time since I opened an account. I was trying to help someone open an account with them during the week. So that's one thing to maybe look into. Actually, if we go to register now, actually I won't click, just in case some personal information. Actually, I'll throw it over on the screen just to see now. If I go to register now, yeah, okay, we're grand. I have an ad blocker on at the moment, so because I was just on some news websites, the ads just get the better of you, to be honest. So you have, so we'll just I'll just show you here now. If we go into the trading platforms, so web trading, AvaTrade Go, that's the app on your phone. Very, very, very simple to use. You just input the amount that you want, or the lot size, plain and simple. So amount is the units, and the lot size is the point something. So if you're trading standard, it's 1, mini 0.1, and micro it's 0.01, right? So trading made simple. You don't do your charting or anything off the app. The app is horrible for all that stuff, but it's very, very quick. Provided you have a good internet connection or whatever, you shouldn't have any issues. You're automatically connected with someone, not necessarily in your country, but someone that speaks your own language. So if you are native to a foreign tongue, you can get your Polish, Portuguese, Romanian, Russian, whatever you need. You can get it. They have lots and lots of support on their thing. You can get it on both Android and Apple, so there's no issues there. They do show iPhones here, iPhone 11s, but there's you don't necessarily have to. Obviously, if you have a better phone, you're going to have better responsiveness and whatever. Like I have a Samsung phone there. It works. All you need is a phone and a internet connection to actually trade. Personally, I think trading from your phone doesn't work. Trading just from your phone, I need my charts. I can't trade without my charts, and that's the truth. I can't trade without my charts. I need the charts to be there to trade and be able to see something nice, big, strong on the screen. There's nothing better than it, to be honest. it's so much easier to see things, and you're not there on your phone trying to swipe and zoom in on a candle to try and figure it out. Or typically, like, some people love to have their charts set up with the auto scroll feature on it to keep things really, really consistent. So if you do auto fit static to screen, when you scroll across, it'll just shift the chart. That drives me nuts. I can't handle that. You can set it so it'll rescale, so you can have a set kind of range always. Like, you can change this over to be percentages, so you could have it set that you can only ever see 5% moves. So if you turn off that actually locks to the screen then, because it's done off percentages. So they want to keep it the ratio right of what you can see. So I just always trade candlesticks. So as you can see up here, candlesticks. You can do your hollow candles if you want. I just find it's a little bit kind of too bright. I like having my little bit of contrast. I have my color team set up to I have gold purple contrast as well. I just think sometimes when looking at the green and red, when you're trying to spot something, just changing the color team makes things pop. I have my blackout one as well, blacked out, no bias. So it's just basically you don't get thrown off by colors. It's really, really handy there. But red green contrast is the best. You can have the standard dark mode. If you want to have dark mode on, you can go color team light, which is just like the kind of pasty pastel color, and red green contrast is a nice one. So right, just do a quick little bit of pre-market. So just by simply looking at this, we can see the euro, or the quoted dollars. So the dollar is obviously showing strength, so the dollar is showing strong. So the dollar, when it's in the base, is showing strength. So the obviously dollar in the base position, and you see red. No, sorry, if you see green with dollar in the base position, it's showing strength. So when we look at the quoted ones, we can see that there's strength in the dollar, because it's traded against another currency, and the dollar is taking control over to the downside, because the strength in the euro is the one that's driving the price. So you're getting less euros for your dollar, right? So, or sorry, you're getting less dollars for the euro, right? Because dollar is more valuable than when quoted against the euro. So, but across the board, the dollar is stronger, so you get less dollars with your native currency. I did a whole video on that. I'm not going to go through that again, because that's, if you haven't, just go and watch the video on currency correlation. There was a move there last week. Last week, I think it was last Tuesday, or Monday, where all the market went. It was the perfect day where all the euro, I keep saying the euro, all the dollar quoted currencies all moved down, and all the dollar base currencies went up, right? So we have USD CAD, USD CHF, and USD JPY. They all went up, and NZD, or say the Kiwi dollar, Aussie dollar, pound dollar, and the euro dollar all went down, and they all went down by about 0.5%, which is a nice move. And if you had a strategy based off of the Dixie, so if you have the dollar index open, which is the Dixie as it's known, the forex indices, and we've opened the Dixie, so we can see that impulsive move on the Dixie from earlier in the week. So if we go back to, I can't remember what day that I put up the video, but when you see a massive impulsive move, that just means that there's a considerable there's considerable pressure in whatever direction. And I mentioned about flipping the chart. So if you invert the scale, if you're trading primarily the dollar quoted currencies, when you see this go up, that's when you know it's you're going to invert the chart. So if you're trading them, because when we see this go up, this is going to go down when we think it's going up, but these are all going to go down. So it's confusing. I explained it in the video, so go and watch my video on currency correlation, and it'll lay all that out in black and white for you. So there's no issues there. I'm actually after going over by 15 minutes, so we're gonna call things quits now in a minute. So we'll just open up a euro chart again, so we can see, look, there's the strength in the dollar very, very clearly by this. Just by looking at this, we'll just give a quick little brief one. GJ for this week, I'm still bearish. I'm bearish on GJ for the foreseeable future. We're after breaking this level here, and I can just see this continuing for a good while, unless we can see price starting to react in this zone, coming over from here. Like, I've been trading GJ a good bit lately, so if we see when price comes down to this level, well, it should come down to this level. If we say plot a fib off of this, so we can see price come down, we're not really seeing any considerable retracements. So if we just do a quick one off of this level, so movement from there to there, like, there's nothing, we're pulling up to the 7. So if we take that first impulse, so the price came down to here, retraced up to here, came back down, and over time, obviously, it came down to the level that we were expecting it to, based off of a short retracement. So short retracement blows down further than you'd expect it to. So look, we went into the Fibonacci retracement tool a good bit today, and I hope I didn't confuse anyone. I will bring a video probably this week going into a bit of detail with maybe a strategy that could be revolved around it, or kind of examples of where the Fibonacci retracement would actually be quite the good tool to be looking at. But I do have a lot of previous lines and stuff. As you can see, this chart is completely destroyed with data just from buys and sells marked in on the chart from ages and ages and ages and ages ago. So yeah, so like, look, lads, I think we're after covering a good bit today, and just quickly, Bitcoin wise, I've been very, very bullish on Bitcoin over the last good while. Yeah, so I've been very, very bullish on Bitcoin over the last while, and we did get close to the all-time high again, the closest we've been in the last couple of weeks. So seeing how things go up in this kind of region, so if we knock it back down to the 1 hour, please don't go too noisy, right, we'll just put it up to that. So look, we can see that we are finding a lot of kind of resistance in this zone here. So we're kind of, so this line here is starting to show kind of SR flip, so support and resistance flip just basically means it's flipping support and resistance over and over and over. So we can have support and resistance flips and SR flip over time, because we can see price came up, broke through, and we can just see price going, oh, found a support here, came up, bang, oh, resistance, and then going along, oh, hit it as resistance, broke through, support. That this here, the 38,350, and I've been talking about the 38,350 a good bit over the last couple of days, because price has been flipping around. Look, price came up to it, hit it, came down, oh, came up, tested it, oh, false breakout, boom, up to the upside. So, and price came down, tipped off it, came back up. I was expecting price to come back down because we set up a Fibonacci retracement, and that's the whole reason we were talking about it tonight, because this setup that I had on the Bitcoin chart. So basically what I was thinking was price came and retraced the whole way up to here, so I had a price target here at 57,550, but obviously you don't set your take profits at 57,550, because as I said, you need that buffer, because otherwise you'll just get stopped out, or you won't get stopped out, you will miss your take profit if the market doesn't have a considerable move. With Bitcoin, in the past, through my experience, I find that it does nearly always get to the level, but I'd hate to not be in a really, really good position and not take the profit and not miss out on that 2 to 5 pips that, you know, that you could have missed out on. Because a lot of times, like, what's more detrimental mentally than actually losing a position is nearly making a position and losing half of it. Because if you make if you do all the analysis perfect and you just miss out on one little bit, sure, you may as well have not taken the trade at all. Well, look, you were in profit, but you didn't make half the profit that you should have, realistically. So look, lads, I think we're going to wrap up things there. I hope everyone enjoyed. If you have any questions, don't hesitate to drop them here in the comments. I'll come back and check them over the next couple of days. And if you want to DM me on Instagram, at X91Investing, you can see it down just here. I don't know if this is the right way. No, I'll have to do it that way maybe. Just there, just beside the camera. And yeah, just send me a message there. Yeah, and I'll get back to you as soon as I can. Yeah, look, lads, I'm very, very grateful for anyone that stuck around for the whole thing. It was definitely a valuable one. That Fibonacci retracement tool is probably the best thing you will ever teach yourself. But look, lads, open an account with AvaTrade, or if you're only throwing €100 is the minimum deposit on AvaTrade, by the way. So, and if you're putting 100, you may as well put 2, because 200, you have double the amount you can trade with then. And, like I could say that again, if you're putting 200, you may as well put 5. If you're putting 5, you may as well put $1,000. But like, if you're only getting into things, trade demo for a while would be my recommendation. You see, by trading demo, you don't get the psychological, you don't really feel the psychology, and you don't really understand the psychology until you trade live. You need to trade live because you don't get that sickening feeling when you see a trade going the wrong way, that the next time you open a position, you're going to feel that as well, if you get me. So you'll remember it from the last time it happened, and you'll learn from it. That's the biggest thing about it. So lads, look, thanks very much for watching. This has been quite a long one, one of the longest ones we've done in a while. How long has it been running on for? Just quickly check it. We have 1 hour and 23 minutes. But look, lads, thanks very much to anyone that stuck around. Definitely means an absolute mountain to me, because I love all this stuff. I've been trading with a long time now, and I feel I'm confident enough to share this information with anyone that wants it. So look, lads, thanks very much for watching, and I'll see you all soon.